Everybody. My name is Luke Robinson, and I'm a business advisor here at Collective. And I've got to say, I'm really excited to be here. This is one of my favorite days of the week, to be honest with you. Tuesday. It's Tuesday today. And what that means is that we have a Tax Tuesday session here today. And essentially, what it is it's an AMA. It's an Ask Me Anything over taxes, over US taxes, of course. Because here at Collective, we're your all-in-one financial solution. We're your all-in-one tax solution, your accounting solution, your payroll solution. We do it all. So if you're a self-employed owner with your own business and is tired of juggling all the hats you have to juggle and running your business, along with doing all the administration and taxes, then Collective is your place. We'll take it off your hands. But in the meantime, let's answer some questions. Let's answer some tax questions. And I believe that I already have some lined up for today. Oh, okay, this is an excellent question, this first one. Do you have to pay quarterly taxes if you just started your business and aren't profitable yet? Well, that's a very good question. And the short answer to that question is yes. Just because you aren't, so estimated taxes, they are what the name implies, of course. They're estimated taxes. So in order to estimate your taxes, you have to estimate your income. So for example, just because you aren't profitable yet, let's say that it's, it's June in this year. Let's say you've been running business for a few months in 2023 and you aren't profitable yet. You haven't made any money. That doesn't really matter. The IRS requires you to pay estimated taxes if you expect to owe $1,000 or more in tax for the year, which means that let's say that you're doing business near the beginning of the year, haven't made any money yet, but you expect in your mind that later on you'll make enough money to where you'll owe $1,000 in taxes for that tax year. You are required to make estimated tax deposits. So you could have a loss, in the first quarter of the year, but if you expect that loss to turn positive, later on, and you expect to owe taxes later on, then you would still be required to pay the estimated tax deposit in that first quarter. They're pretty ironclad about that. But thankfully, the only thing that'll happen, though, if you miss an estimated tax deposit or something like that, is that typically you'll just get penalized. And the penalties typically aren't huge. You're not going to tax jail or anything like that if you don't make an estimated tax deposit. So if if you're a little late on it and you didn't really understand the rules before starting a business, that's okay. It's not the end of the world. Oh, this is another excellent question. This is the best question I've gotten in a while. I do video reviews for Amazon products. Can the products I review be written off even if I use them personally? Well, the answer to that is partly. So really, in order to write something exclusively off for business, tax professionals typically say two things. They'll say, and the IRS does too. The IRS will say that a business expense, in order for it to be written off, it has to be both necessary and ordinary in the course of business. But I think that one word is left out that's important, and it also has to be exclusively used for business if you want to write off the entire thing. So, for example, let's say that you were doing reviews for Amazon, buying products, and the only way you were using those products were to review them for your business. You weren't using them personally at all. You might even throw them away or resell them, when you're done. That when you actually buy those products in that situation, that is as far as the tax laws go, that is a completely allowable business expense. There's no reason why you couldn't write that off. But let's say that you use them personally. Let's say that you buy a hair dryer from Amazon to review it. And of course, you do a demonstration and you review it for Amazon. That's all, business purposes. But let's say that you keep that hair dryer after that and you use it more for personal hair drying solution. Then At that point, you'd have to figure out what portion, how much time did you spend when you used that hairdryer personally, and how much time did you spend when you used it for business? You can only write off the portion of the expense that is applicable to business. So if the hairdryer is, $50 in total, and you only think that, for you used 10% of its life, simply for business, you can only write 10% off of that $50. The rest would be a personal cost, and that's not a business expense. But that's an excellent question. Okay. Okay, here's another good question. What are the difference between estimated taxes and income taxes? Well, there isn't really a difference in the sense that when you pay estimated taxes, part of that is to cover income taxes throughout the year. But your estimated taxes also serve to cover all your other types of taxes too. So your self-employment taxes, that's another one. That's something that's completely separate from income taxes. And you still have to pay those. So the estimated tax deposits cover estimated taxes. They also cover some sort of alternative minimum tax that you might be subject to once you file your return. They also cover things like capital gains, like if you sell something during the year and like a property or something like that, and you make a profit on it. Typically, it depends on your basis and depends on your investments into that property, but you will have a capital gain when you sell that property, and that capital gain is subject to capital gain tax rates. But your estimated tax deposits will cover those throughout the year. So there really isn't a difference between taxes and estimated taxes. It's just that estimated taxes cover all types of taxes. How does an S corp come to play with estimated taxes? I'm glad you asked, because collective, that's what we specialize in. We're an S corp company. And really, the main reason why someone would make an S corp election or become an S corp is to save on the self-employment tax. That's the whole reason. So let's say that, which, estimated taxes, of course, cover the self-employment tax. So let's say that you're making $100,000 as a self-employed person, either, as a sole proprietorship, which means, of course, no business entity set up, or as a LLC. It doesn't matter. All of your money, let's say that you're making $100,000 in that situation. Doesn't matter if you're a sole proprietorship, you're an LLC, all of your money is subject to the self-employment tax. And the self-employment tax is a flat rate of 15.3%. It's not like income taxes. Income taxes are marginal rates to where, a portion of your money is charged a certain tax rate, the next portion of your money is charged another tax rate, and so on and so forth. The self-employment tax is simply 15.3% flat tax. When you become an S corp, or when you make an S corp election, that's the technical name for it. And technically, you have to be a business entity first, like an LLC, before you can even make an S corp election. So what collective would do is the first step we take, if you don't already have one in place, we'd set up an LLC in your state of residence. That's the first step. Then we'll make an S corp election on that LLC with the IRS. That's where you send the paperwork in to become an S corp and into the feds, the Internal Revenue Service. And what that does, technically speaking, that turns you in to an employee, into a W-2 employee of your own business, of your own LLC. You're still the owner, of course. You're still the owner of this business. You're still listed on the company formation documents as the owner. But for tax purposes, you literally become an employee. So since you're an employee now, your business pays you an employee wage. It pays you a salary just like you would make if you worked for someone else or some other company as a W-2 employee. But the advantageous aspect of S corps is that the only chunk of your earnings in total that's subject to the self-employment tax now with an S corp is your salary. The rest is business profit or a dividend or a distribution, however you'd like to think of it. And the rest of the money is not subject to the self-employment tax at all. So, for example, let's say that someone makes $100,000 and they elect S corp tax status. And let's assume that a reasonable salary for whatever industry they're involved with is $45,000. Just make that as an assumption. That first $45,000 is still subject to the self-employment tax. You can kind of think of it as a payroll tax. That's essentially what it is. But the other, what is that, 55? Yes. The other 55 grand, those are considered distributions. And it's still your income. You still have access to this money at all times. You don't have to leave these distributions in your business bank account. You can take out these withdrawals, these distributions, and pay yourself personally whenever you'd like. But that chunk of money is not subject to the self-employment tax at all. So, giving that example, that leaves $55,000 that will not be subject to the self-employment tax. So, if we do some quick calculations on the 15.3% self-employment tax, if that's no longer going to be charged, how we'd come up with our tax savings is to take $55,000 and multiply it by 15.3%. That's how you can determine how much an S corp would save you. And in a situation like that, an S corp would save someone $8,400 a year in the self-employment tax. And I mean, as you can see, if someone makes 100 grand in total, that's almost 10% of their entire income. That's a substantial amount of money when you're working day in and day out in a business. You want to hold on to every dollar that you can. So that's why it's so important to consider S corp once you reach these levels in your business. And we would love it if you would like to speak about this with a collective professional. And what you can do is just DM us, send us a direct message, and ask for a link to set up a call with a tax advisor. And at Collective, we'll go through your entire situation, determine whether or not an S corp is worth it for you, determine whether or not Collective would be a good fit for your business. And if it is, we'll talk about next steps and how to get you going. But if it's not, we'll give you some referrals to some partners we have that could help you. But in the meantime, we'd love to have a conversation with you. But let's continue on with our questions. How does retirement work with S corps? Well, the retirement rules are pretty specific. So it kind of depends on your individual situation as to what exact steps you could take. But what I can say is that just as a self-employed person in general, a person that owns a business, has an increased sort of opportunity to save for retirement as opposed to people that work for other people that are paid wages, things like that. When you're an employee of another company, when you work for someone else, typically you can only contribute up to the individual retirement limit to your retirement account, which for most people, I want to say is around the $20,000 mark. With an S, and that includes any employee contributions too. Like your employer can't dump money on top of your personal contributions into your retirement account. But when you own an S corp, when you're an employee / owner of an S corp, you as an employee of your own business can contribute up to the limit, up to the $20,000 limit or whatever that is. And then the S corp can then dump money on top of those individual contributions. And I've seen people put back, up to $65,000 in tax-free retirement savings. So, and like I said, the rules, kind of differ and depend on what type of retirement account you plan on opening, things like that. But in general, an S corp and just being self-employed in general is fantastic for retirement opportunities. Can you rent an apartment for an employee with a C corp? I mean, Technically, you could even probably include that as, part of that as a wages, and write that off as a business expense. But yeah, just generally, you can rent an apartment for an employee. Are we servicing e-commerce now? Yes, we are. So here's the caveat is that we are in the space of e-commerce. We can, potentially serve you if you are an e-commerce person. But the only thing is that you can't track inventory yourself. If your books require tracking inventory, which a lot of e-commerce people they don't. They don't have inventory requirements because a lot of times the platforms they're selling their products on will take care of inventory, will also take care of sales tax, and there's just certain requirements below certain levels that don't require inventory tracking. So if you are an e-commerce person and you are pretty sure that none of your finances include tracking inventory, then Collective could take you on. Absolutely. And what we can do too is let's say that you're an e-commerce professional and you're interested. Schedule a call with us. We'll talk through your situation, kind of see if Collective would be a good fit, and we'll go from there. But yeah, at this point in time, we are accepting e-commerce professionals. Will an S corp affect my estimated taxes? Yes. So when you're an S corp, even though you're getting paid as an employee, getting paid a paycheck and everything like that, you're still technically required to pay estimated taxes. So, but they will change in the sense that theoretically they should go down. So when you're a sole proprietor, estimated taxes cover all types of taxes, self-employment tax, income tax. It's subject to all of it. So when you're an LLC or a sole proprietorship, all of your money is subject to the self-employment tax. So you're paying more self-employment tax when you're a sole proprietorship or an LLC. So therefore, your estimated tax deposits are higher. But when you elect S corp tax status, your self-employment tax goes down. So therefore, that directly correlates into lower estimated tax payments. So for example, every quarter when you're an LLC, your estimated tax payments might be $10,000 a quarter. But let's say you elect S corp tax status, it could very well jump to $7,500 a quarter instead. I mean, our average member saves around $11,000, but there's a lot of people I speak to that kind of depending on their income levels, they're saving $15,000 a year or $20,000 a year with an S corp election. So if you're one of those individuals, you could see your estimated tax deposits be reduced by thousands of dollars. Can you backdate an S corp election? I am so glad you asked because first off, yes, it is possible to backdate an S corp election under certain conditions. And essentially what that means is you have to have a business entity in existence to backdate an S corp election. So let's say that this year you've been running your business as a sole proprietorship. You don't have any sort of LLC set up or anything like that. That cannot be backdated. If you've been doing business, let's say that for January, February, March, April, May, you did business as a sole proprietorship. All the money that you made within those months are sole proprietorship money. They can't be roped under the S corp tax rules. We can't backdate it. But let's say that you set up an LLC back in the beginning of this year. Excuse me. And let's say you set up an LLC back in January 1st, let's say. Since you have an LLC in place, we can backdate the S corp election to January 1st, but only if you have an LLC in place. And Collective, there actually is a deadline for that. If you join Collective by July, by the end of this month, by June 30th, or let me see how many days are in this month. Yes, 30. If you join Collective by June 30th, we'll be able to backdate your S corp election to the beginning of this year, till January 1st, 2023. So any money that you've made since January 1st onward can be roped under the S Corp tax rules, but only if you join by June 30th. Because after June, after this month is over, we won't be able to backdate an S Corp election anymore. And the reason that is because there's a lot of work involved when you backdate an S Corp election. It's not simply just, sending in a form. What you have to do when you backdate is, first off, you do have to understand how to fill out the form correctly. When you backdate an S Corp election, oftentimes you're making a late S Corp election, and that has to have a specific argument to be done, to be presented to the IRS. So it's still important to get a professional to actually make the S Corp election. But to backdate it, you have to do a few things. First off, you have to run back payroll, because part of the point of becoming an S Corp is to get on payroll, is to become an employee. And if you've already made money, as far as the government's concerned, that's all sole proprietorship money. So you have to go back and literally reclassify some of that as payroll and reclassify some of that as distributions. That takes time. It takes many hours for our staff to get that done. And after June, it's just too much work to where it would be so expensive that the S Corp tax savings you get wouldn't even be worth backdating the S Corp election. But it certainly is if you can get it done in June, because usually we charge a very modest fee to backdate the entire year. And usually that saves people thousands upon thousands of dollars. So yes, to answer this question, you can backdate an S Corp election. I would just get a phone call scheduled with Collective well before the end of this month, so we can go through your situation, check and see if your S Corp even needs to be backdated. Maybe it's not quite time yet. And here at Collective, it's important to us that we don't take on any members. We don't sign anyone up unless we know that we can help them, unless we've done some sort of analysis that shows we can save them money, save them time, things like that. If it's not ready, if you're not quite ready for it yet, then we'll tell you in this consultation, and we'll give you some referrals, or we'll stay in touch to when you are ready. And we won't sell you anything that you're not that you don't need at this moment in time. Okay. Looks like we have another question coming in here. Can a partnership be an S Corp? Yes, a partnership can make an S Corp election. And before I go into that, there's really three main things that can make an S Corp election. One is an LLC, a single member LLC, which is just one person on an LLC, obviously. A partnership is simply just a multi-member LLC. That's what a partnership is. When you have multiple people in certain context, when you have multiple people on an LLC, the IRS automatically determines that as a partnership. They automatically recognize you as a partnership. So that's the second entity that can elect S Corp tax status. The third is a corporation, a C corporation. All of these entities can elect S Corp tax status, and all of them are formed with your state of residence. So that's the first thing that I would say. But the thing is, though, that when deciding between an LLC or a corporation, a good rule of thumb is a vast majority of people need to be an LLC. They need to have an LLC set up before they elect an S Corp tax status. The only reason why you'd want to form a corporation is if you ever wanted to go public, if you ever wanted to issue stock on yourself, things like that. If you ever wanted more than 100 shareholders in your business, that's another thing. So a C corporation does allow you to, it gives you that flexibility, but that does not apply to a vast majority of small business owners. And the downside to that, the downside to having a corporation, is you have additional administrative requirements. Technically, you're supposed to have a board of directors, have annual meetings of these board of directors, keep records of the meetings, keep meeting minutes. There's several things that you have to do with a corporation that you don't have to do with an LLC. And the LLC gives you the same legal protection that a corporation does. There is no additional legal protection when you form a corporation over an LLC. Not at all. The only benefit is if you ever wanted to go public, but that doesn't apply to a vast majority of people. Okay. My accountant suggested that I become a C corp as opposed to an LLC. Why would they do that? That completely that depends, to be honest with you. That depends on your personal situation because there are rare sort of one-off situations where a corporation would be better. Um, so, like for example, when you have a corporation and you don't elect S corp tax status or do anything like that, you are subject to double taxation in the sense that there are corporate taxes that the corporation pays on its income first. And then that income gets passed through to you, and then you pay personal taxes on all that income. It gets taxed twice. But when you have an LLC, it's a pass-through entity. It only gets taxed once. There is no corporate taxes for LLCs, but there are for corporations. But to avoid that double taxation, though, there are a few strategies that people employ. One is to zero out the actual corporation's income by paying the owner of the corporation a salary, which is a deductible expense for that corporation. So, for example, let's say the corporation has $150,000 in income, but that corporation pays the sole owner of the corporation a wage of $150,000. That money is taxable to the employee of the corporation because it's a wage, of course, and they have to pay taxes on it, just like you would be if you worked for someone else or whatnot. But the corporation itself doesn't actually pay taxes. There's no corporate tax because you've zeroed out the corporate income by paying all that money through a salary. But again, that can be complicated, and it just simply does not apply to a vast majority of people. Maybe you have something very specific about your situation that would make this better. But for a lot of people, it's kind of a nightmare. I'd certainly go with an LLC. And I have time for one more question. I think there is one coming in. I don't quite understand. What's the difference between an S corp and a C corp? So an S corp is a tax election. It's not a business entity by itself. So like I said, either an LLC, a corporation, a partnership, they can all elect S corp tax status, which changes how you're taxed. But a C corp, that's not a tax status. That is a business entity. It's a corporation essentially. So that's the difference. But C corps can elect S corp tax status. So keep that in mind. And unfortunately, that's all the time that we have left for this week's Tax Tuesday. I actually have another call with a prospective collective member, but I so enjoyed it as always. And like I said earlier, please, if you found this conversation useful, if you think that collective could be beneficial for your business, or you're just interested in becoming an S corp, schedule a call with us. Either go to our website, you can schedule a call there, reach out to us on social media, send us a message, and we'll send you a schedule link. And we'd love to talk through your situation and see what would be best for you to do next. But in the meantime, I'm going to have to let everyone go. I will see everyone next week.